Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today's Thursday. It's July 14th. Market's going to open up in about an hour and 31 minutes to be exact with you. Now, I'm noticing the market actually didn't do so bad yesterday following the CPI number, but right now it's foiled. And what I've been noticing, and this is something you want to pay attention to. Oh, by the way, before I get into the analysis, before I get what's into important, remember something. This is the last time Jeff Zananeri is doing his link class. He's going to give you a long and a short if you attend the class at 1 p.m. Eastern time today. The link is below this video. If you're watching on YouTube channel, it's below this video. Don't miss out. 1 p.m. Jeff Zananeri live. Red meat, long trade and short trade. And I'm going to give you a top ETF and an option if you stick with me for a while longer here. Now, here's what's interesting, and here's what I've been noticing. The U.S. market has been sustaining or getting past negative data by going higher lately. And then overnight, the European market sags based on that data that the U.S. got, and it causes the market in the U.S. to open lower as well. I've noticed this pattern already in the last 4 or 5 reports. So it seems like U.S. economy is able to shrug off the U.S. data, but the global economy is having trouble with it right now. And then overnight, it's impacting the U.S. from the other way around. In other words, U.S. data is being okay when it comes out. It's not being too negative. It's reacting well. But then overnight, the European data comes out. They're really doing bad right now, and it puts a negative impact or a negative spin on U.S. data. Notice that next couple of sessions. Like yesterday, we didn't really sag off too much towards the end of the day. We closed positive. And look at the Dow now, it's down 400 points. And I've been seeing that pattern. That's actually not the worst thing in the world, the fact that U.S. markets are now reacting positive to negative data. That's actually a pretty good sign. Now, I'll get into the news in a minute from yesterday into the CPI. But today, in about 29 minutes, we have the PPI, the Producers Price Index, not nearly as important as the CPI, but it will give us some clues on how inflationary pressure and the supply chain and the war and all the other good stuff like COVID is impacting producers. And as you can see here, the final year-to-year number, I don't really care about month-to-month, that's noise, but year-to-year, they're looking at 10.4% upside. And the number's pretty tight, 10.4, 10.9. So it'll be very interesting what we hit within range. The other report that's coming out is the jobless claims. And as you can see here, the number is also fairly reasonable. And I'm not looking for any major disappointments. The truth is, the number has been in line with the 4-week moving average. And unless the number's like 350,000 or like 100,000, it's not going to matter. 5,000, 4,000 here or there, it won't matter. The biggest factor is going to be the PPI, and if this number jumps above 10.4 or above 10.9, which is the expectation. And ex-food and energy is also what we're looking at, and we're looking for this number to be lower compared to the prior number. If that's the case, there's a chance the core CPI might have peaked out. And if the core CPI has peaked out, that means ex-food and energy, there's a good chance the rest will come down, because we know that food and energy is due to the bottleneck, supply chain, the war, not so much due to the genetic inflationary pressure that we're seeing. And this is not a traditional, because people are still spending. This is not a traditional recessionary economy. Now let's talk a little bit about the current market cycle. So inflation stoked expectations of more rate hikes, which are not going to be making investors happy. But what's really great right now is if you look at the bond market is still maintaining its neutral range, which is really good, which means the long bond is telling us that inflation might have peaked. Look at that. See, it's still within range. And as long as we can stay within range here, it'll be harder for the U.S. discretionary and tech stocks to continue going lower. Because if interest rates are not going higher, why would they go lower, right? And that's a long-term rate right now. And it's still choppy, which is telling me, unless it breaks lower in the near term, that the worst may in fact be behind us. Now, we've had earnings come out this morning on JP Morgan. Let me see here what the expectations were. They were expecting $2.94, down 22% on 32 billion positives, 32 billion revenue, 294. Let's see what the number came out at. So fell 28%, largest 276 8.6 billion, 276. They were expecting 294. Didn't beat it on that front, and a profit of 11.94 billion. The companies that I see in the same period a year ago. So they made 8.6 billion. Yeah, $2.89 were the expectations. So they were a little bit on the downside. According to their CEO, consumer spending is solid. While U.S. economy is growing and job market and consumer spending are solid, a number of factors are very likely to have a negative consequence on global economy, sometimes down the road, including shrinking consumer confidence and the Federal Reserve bringing high inflation under control. And I agree with him on that. This guy's pretty smart. He's not a stupid guy at all by any stretch of the imagination. But anyway, yesterday the number was 9.1. We were expecting a little lower. Core CPI did not increase. As I said, core CPI was within expectations, which means we could be seeing the worst of it. The markets actually rallied based on this news because it means with the inflation this bad, it means there's a higher chance of a recession, which means we may have a new cycle starting soon, or the Fed will take it easy to get the rates under control, because if they move too fast, we'll be in a recession. Federal Reserve, central banks in Britain, South Korea, some other countries have hiked rates to cool inflation. European central banks, similar plan. Traders expect the Fed to rate hike 0.75% next month. There's now a 30-something% chance that it's going to be 100 basis points, but I think that's not going to happen. Fed officials say a recession is possible, but not certain. The point to a strong job market despite higher borrowing. And again, we're looking at major earnings, and energy prices are down now below $1 a barrel. So that's very, very important. Now, semiconductors yesterday went higher on this news. The Russell 2000 yesterday was down 0.15 on this news. So tech stocks did not do very negatively on this. Let's see how consumers did. Consumer closed higher. Like NVIDIA, for example. NVIDIA closed higher yesterday. Now it's down 83 cents. But the point is, this did not have a negative impact on the market, and one of those reasons is because the long bond is not being impacted by it. Now, if you look at the five-day sector analysis, we are as confused can be. You've got energy and consumer staples. You've got the most defensive sector and the most offensive sector competing for the first spot. Yesterday, you had consumer staples and consumer discretionary. It doesn't make any sense. Over a month, you've had healthcare, real estate, and some mixed. So this is telling us that markets are really, really mixed right now. Now, if you look at the cumulative strength index, consumer staples is now leading and energy is the second spot. If you look on a monthly, consumer staples, healthcare, and utilities are leading. I would honestly go with this route right now. And if you look at the sectors, you will see that healthcare is almost at its near-term resistance level. That's consumer staples, sorry. Healthcare is right here next to it. They both look very similar. So I don't know. Healthcare looks like it's dumping a little bit. Consumer staples looks like it's still holding up. I like consumer staples right now, and I like healthcare. And I also like utilities. As you will see, most of the sectors are congesting. They're just consolidating. They're not really doing very much right now, which means we can have a little lower volatility, and we could see some potential upside or more choppiness in the market. As far as the energy sector is concerned, it looks like it's starting to bottom out, but it looks like it's congesting. It looks like everything is congesting, consolidating. It doesn't look like there's major trends running up right now. It looks like markets is trying to find a place. So it'll be very interesting to see how the next few days turn out. Now, the S&P right now looks like it's ready to break lower. Now, if we break below the 372 level, we're probably going to go test the lows once again. I'm going to say that again. If we break the 372 levels, we're probably going to test the lows again. On the Dow, let me give you those levels here. We're literally almost there, and I think we're almost like literally at the lows right now on the Dow. But again, notice we're moving sideways. And so that level on the Dow is 30,000. On the Russell, again, we're in a choppy market. Expect us to stay and not break 163. But 163 is the level. But again, we are definitely moving south right now. But if you look at the major stocks in the S&P, remember it was all energy stocks for a while. You still have Occidental Petroleum leading. But look, you got pharmaceuticals, medical, consumer staples. I think this is discretionary. No, basic materials or something like that. Kellogg's, General Mills. Notice that? Look where Campbell is. Soup. Look at Dollar Tree, Dollar General, AutoZone, Exxon, Hershey's. So I would be careful with the energies right now. I would be very cautious with the energies. But I like the consumer staples, and that's the sector I would be focused on right now. And let me show you the consumer staples right here. Consumer staples. Now, again, we could open down here and cut higher, or we can go a little lower. But honestly, this is the strongest sector right now. And this is the sector that I would be focused on right now. So in terms of options, I would go all the way to December. We got plenty of time. And I think by December, prices will be higher. You can go all the way. You can go to 72, 73. Look at the liquidity here. It's fine. 73 looks really good. It's less than $5. I wouldn't even think twice. I would be buying this right now. And implied volatility is not like 50% or anything like that. So December, 73 call, right around $4, $4.50. You'll be able to get it today, probably for a little cheaper because the market's opening lower. But that's what I'm liking right now. Now, before I let you guys go, one last thing. I've been talking about it all week, but if you haven't seen it, make sure to click the link below. Click the link below, reserve your seat. Jeff Zananeri's big macro analysis has been spot on this year. So I'm really interested in what he has to say, especially after yesterday's inflationary data. He's also giving the details of a hedge fund strategy that Jeff used to make a killing in 2008, all while other traders wore losing shirts with the word loser on their sleeve. Plus, he's giving away a brand new trade opportunity on two, not one, two positions, one long, one short. You guys are going to love this link trade. Again, it's the last time you'll have a chance to catch it. It's happening at 1 p.m. Eastern Time. The link is below this video on the Wealth Press YouTube channel. Or if you're watching on the Wealth Press site, it should be in big red or blue or green letters right below this video. You don't want to miss Jeff Zananeri. 2 red meat trades at 1 p.m. He's giving it to you. Right now, link trades are hot because markets are crazy volatile. So you don't want to miss out. It's happening at 1 p.m. Eastern Time, a long and a short. It'll be a perfect complement to what we're giving you here in the consumer discretionary sector. Comments, feedbacks, emails. I want to hear from you guys. It's been a while. Send me some love letters. Have I been keeping you out of trouble at least? Bye, guys. Take care. Have a great day, and I'll talk to you soon. Bye.